Hello, everyone. Welcome back to another edition of the Week in Charts. Charlie Bilello here. As always, I'm going to run through some of the most interesting charts and themes that we're seeing in markets today. If you're watching this on YouTube, as always, take a moment, hit that subscribe button for more content just like it. I'm going to run through some of the topics here. We're going to be talking about inflation, not going away. Fed needs to hold the line. That's my view. Racing back to all-time highs. That's the S&P 500. Roaring Kitty returns. I can't believe I'm saying this, but the meme stock craze is back. Emerging signs of a leadership change. We're talking about potentially a shift in the stock market's leadership. The Walmart bubble, interesting question there. And we'll end, as we always do, with something positive. That's a return to prosperity for the American worker. All right, so let's start out. Inflation isn't going away. We kind of got a mixed CPI report in terms of some people were happy, some people were not happy. If you're looking at the core number, I think a lot of people were focusing on that as something positive because it was the lowest core inflation rating in the US since April 2021, moved down to 3.6%. Overall number kind of still stuck. 3.4%. It was 3.5% last month, but a lot of people were saying that was going to be below 3% at this point. So I think overall, kind of a mixed report, but the beat goes on in terms of above average inflation. We're talking about 37 consecutive months now of elevated inflation above 3%. That's the longest streak we've seen of high inflation since the late 80s, early 90s. And it seems very likely this is going to continue in the month of May, and we're going to hit 38 consecutive months. Most important component of CPI far and away would be that shelter component. It's what most people spend the most money on each and every month, that housing payment. It's over a third of CPI. The good news is shelter CPI coming down here each and every month over the last 13 months from a peak of 8.2%. That was the highest reading we've seen since the early 1980s. Today, 5.5%. And likely to continue lower. Why do I say that? Because shelter CPI, severely lagging indicator. If you look at real-time rental data, we're seeing prices decline for a while now on a year-over-year basis, and we're still seeing elevated shelter CPI numbers. So as long as these real-time metrics stay in negative territory, I would expect this number to continue to trend lower. And you're going to likely then see that core CPI, which excludes food and energy, and where housing is a huge component, likely to trend lower as well in the months to come. But if we look at housing costs here above 5% in terms of inflation for 25 consecutive months, longest period of high housing inflation since the early 1980s. This is far and away, I think, the most problematic and troublesome thing in the terms of inflation, because it's the biggest component that people are spending money on. And so to have the worst housing inflation since the early 1980s, this is a huge problem. So as we'll talk about in the Fed section, I think just yet another reason why they shouldn't even be thinking about cutting rates at this point in time. So if we're looking at the CPI versus June 2022, when inflation peaked at 9.1%, what we could see here, night and day. I mean, back in 2022, in the middle of 2022, we were seeing huge spikes in commodities, gasoline, fuel oil, gas utilities, just huge surges on a year-over-year basis. Today, we're seeing lower gas utility prices than a year ago, lower fuel oil. If we're looking at gasoline, just barely up year over year. So huge difference. And with the exception of transportation, which is higher today, every single component is lower today than where it was in June 2022. So it's been a broad-based kind of decline in the rate of inflation. That's not to say that prices are lower than back then. It's to say that the rate of inflation in most of these categories, with the exception of transportation, is lower today than back then. And why is transportation higher today? One of the big factors would be that car insurance reading, and car insurance up 23% over the past year. That's the biggest one-year spike we've seen since 1976. And of course, the 1970s, known for that high inflation period, not something you want to be compared to. So hopefully this ends. We've talked about some of the reasons why this is going on. With a lag, we're seeing car insurance companies raise their rates, and they're saying they're doing it because there's been more accidents over the past few years and the cost of cars has gone up. Used cars, new cars, The cost of maintenance and labor has gone up significantly. So they're saying they're adjusting to all of those factors, but definitely painful. Anyone who's gotten a car insurance bill in the past few months, you're just seeing a huge spike. So hopefully this changes and this moderates, and transportation can join those other areas in terms of seeing lower inflation as compared to the middle of 2022. The most absurd number in CPI, I talked about this last month, but I just want to state it again because it's just absolutely insane the way the US government calculates the increase or decrease in health insurance. They're actually saying that health insurance premiums have gone down 12% over the last year and 4% over the last 5 years. And wouldn't that be nice if your health insurance actually reflected what they're saying here? And why are they saying this? They're saying that you should calculate the health insurance premium not based on what people are actually paying, but instead looking at the retained earnings of insurance companies. Absolutely insane. So because they're saying retained earnings are lower for health insurance companies, I don't know how they're calculating that, because it seems like health insurance companies are doing pretty well these days. But because they're saying they are lower, therefore they're saying your premium is lower, which is absolutely ridiculous. So you have to just dig into some of these numbers at times to say this doesn't really make sense with reality. The actual cost of health insurance is way up over the last 5 years. So certainly this is just one example to say that likely inflation is higher than what the government is saying it is. And if we look at the best way to protect yourself against higher prices in the long run, it's to be an investor, whether it's a stock market, real estate. Cash flow generating assets have been historically the best way to not only keep pace with inflation, but exceed it. And what I'm showing you here is the purchasing power of your dollar is eroding every single day because of inflation. Every single year, it's becoming worth less and less because of that inflation. So if you just have your money sitting in a checking account, earning nothing, or underneath your mattress, you're actually losing because the value of that dollar is going down because things cost more year after year. So we can see here, S&P 500, this is adjusted for inflation, is actually up 840% over the past 30 years. That's over 7% per year above the rate of inflation. So just absolutely a great place to be in the last 30 years, hopefully be in the next 30 years as well. But as an investor, you have to be thinking about this in the long run. In any given year, the S&P 500 could be below the rate of inflation. But as you go out longer and longer in time, your odds of exceeding the rate of inflation increase. So as an investor, you have to think long term, and you have to be thinking about inflation in the future, because again, I don't think it's going away. If you look at, we've talked about the deficits, we've talked about the national debt, it doesn't seem very likely that we're going to see lower prices anytime soon. So how should you be thinking about inflation impacting your portfolio? Creative planning, we spent a lot of time thinking about that. So reach out today for a second look. I'll have a link in the show notes, creatingplanning.com/Charlie. We're in all 50 states. So set up a call, set up a meeting. Over 300 billion in assets under management and advisement. We're here to help. So definitely reach out today. I'll have a link again in the show notes for you to set up a call or a meeting. Number two here, the Fed needs to hold the line. This is obviously my opinion. Some people would argue the Fed should have already cut rates. Many people are saying that. I don't agree whatsoever. I think not only CPI is suggesting that inflation is not going away, but we're seeing some other areas that had been promising and kind of helping keep prices lower are now moving in the opposite direction. One of these being producer prices, which are now up 2% over the last year, highest since April 2023. And we saw in 2020 and 2021, this kind of lead the consumer price index higher, and actually peaked before the consumer price index peaked. So perhaps if this continues higher, we're going to see higher cost of goods, consumer goods, because you're seeing higher input costs. So I'm going to talk about later about the price of copper has been going up. We're seeing that in other metals, other commodities start to be higher on a year-over-year basis. So perhaps this is going to continue to trend higher. Definitely something to watch. We're also seeing import prices, which had been definitely helpful in terms of seeing year-over-year declines. We're kind of importing deflation from China, where they were lowering the prices of goods, and that was very helpful for a number of months. But now we're seeing a reversal here, with import prices up 1% over the last year. That's the highest increase since December 2022. Another thing to watch. And in terms of the May CPI report, we're not going to see this just go right below 3%. Not likely at all. The Cleveland Fed's expecting 3.4%. I think that's probably about right. 3.4, 3.5, depending on how that number comes in. Core inflation, they're expecting to come down a little bit more. And I think that's just all dependent on that shelter number. So if that comes in better than expected, you could see an even bigger decline. But overall point is we're not at 2%. The Fed's target, we're still ways away from 2%. And we have that cumulative inflation that we've seen since 2020 well above that 2%. So what I've argued is the Fed shouldn't even be thinking about cutting rates until we're below 2% for a period of months, and just getting back to 2% is not enough. And certainly being at 3.4% where we are today, definitely not enough. And I think Powell, more and more, if you listen to him speak, I think he's saying the right things on this. I think he's talking in Amsterdam the other day, saying that inflation is higher than anybody expected. So definitely, if you look at the Fed's projections entering the year versus today, inflation has been higher, and we'll need to be patient and let restrictive policy do its work. And essentially, higher interest rates take time to help inflation lower, to help bring down demand. I think it's working in terms of, if we're looking at car prices, we're looking at homes, and in terms of the housing activity, where would the cost of housing be if the Fed didn't raise interest rates as much as they did? It would probably be a lot higher than where it is today. So let restrictive policy do its work. And I think the market is coming around to that expectation that the Fed is going to be higher for longer unless the data really changes significantly. And so what I'm showing you here is the huge change in market expectations from the start of the year, where the market was saying the Fed was going to cut rates 6 to 7 times, and they were going to do the first cut in March. And now here we are in mid-May, and the market's saying only maybe 1 to 2 rate cuts this year, with the first cut not happening until September. So huge shift. And in terms of the balance sheet, the Fed, as we talked about, said in their last meeting, unfortunately, that they're going to slow the pace of quantitative tightening, but they're still going to continue to let it run off. And I think that's absolutely the right thing to be doing here, even though we just hit a milestone this week. The drawdown in the Fed's balance sheet now is actually the biggest we've seen, 18.5% off of that April 2022 peak, biggest we've seen in history in terms of the Fed's balance sheet, exceeded the decline in the balance sheet, which bottomed in August 2019 and early 2009. So exceeding those. And again, we're still going to let runoff continue, just at a slower pace. If it was up to me, I would do it at a faster pace. I certainly wouldn't have slowed it down. And the reason for that is we're nowhere near back to normal. We've come down 1.7 trillion, which is a great start. But why can't we get back to where we were in 2020 before we had that massive spike in quantitative easing? Why can't we go back to a state of normal, would be my question here. And it's a dangerous thing if the Fed cannot go back to a state of normal after a period of crisis, right? The crisis is over. The problem today is inflation. So why not get out of the bond market? Don't make the same mistake again in terms of manipulating the mortgage market, which is one of the reasons why the housing market is in that stalemate that it's in today, is the fact that the Fed felt it necessary during a housing bubble to buy trillions of dollars of mortgage bonds to drive those interest rates lower. That should be a mistake that they're never allowed to make again in the future. And so what Powell's saying is let higher rates do the work. And I think in terms of used car prices here, you can see it's just going to take some more time, right? It's working. If we look at the peak in terms of car prices, was right around when the Fed started to become restrictive in terms of monetary policy, starting to tighten, stopping the quantitative easing. And now we've seen the lowest wholesale used prices that we've seen since March 2021. And so if we keep that restrictive policy in place, I would expect this to continue to move lower. And what we're seeing in terms of the car market, the big factor being interest rates, the big factor being affordability, because most people finance the cost of a car. So when the Fed was manipulating interest rates lower and cars, the cost of financing was zero, there was just more demand than there would otherwise would be naturally. And today you have a more normal market where people actually have to decide, well, is this something I can afford or not afford? And demand has pulled back, and that's helped with the fact that prices for cars are coming lower. And you want to see that continue. As long as wages are going up, I very much want to see prices for things like cars come down, and hopefully this will be a trend that continues. So stock market very quickly here back to new all-time highs. What a quick period of time. It was only a month ago we're talking about that pullback, not a big pullback, but 6%. Felt like a lot because in the first 2 months of this year, 3 months, we saw almost no volatility at all. Then we had that April pullback, 6%. And kind of funny because one of the big reasons the market was saying that market participants were saying why stocks were going down, well, they said it was because inflation is high and that the Fed is no longer going to cut interest rates in June. And here we are, inflation is still high. The Fed is still not going to cut interest rates in June, but the market doesn't seem to care about that whatsoever anymore. So the narrative has really shifted here very quickly. S&P 500 moving back to new highs and significantly higher than where it was back in 2022 and when the Fed started hiking interest rates. So this notion that the stock market can't go up with the Fed hiking interest rates, absolutely false. It's always been false in the past, and it's been false this time around. Interest rates are not the factor that people think they are when it comes to the stock market. Actually, stock market has higher returns historically when interest rates are rising over the past year rather than falling. The worst thing for stocks is when interest rates fall very quickly, because it usually means a deflationary environment, a recessionary environment where corporate profits go down. So Fed funds rate where it is today absolutely doesn't seem to be hurting the stock market. S&P 500 hit its 23rd all-time high of the year this week, and it hit a new milestone above 5,300 and just 56 trading days after the last one. And this is a great chart that I love to show. These were the projections for strategists entering the year in terms of the price targets for the S&P 500, and we're already above every single one with the exception of one, and we're only in the middle of May. So S&P 500 now is 9% above the average target entering the year, and just another reason why you should just throw out every single forecast when it comes to the stock market. No one can predict the short run. The Dow hit 40,000 this week for the first time. Just incredible. Where it was just a few years ago during COVID in March 2020, actually dipped below 19,000 for a brief moment back then, and just an incredible run, incredible recovery since the depths in March 2020. Dow 40,000, and so market participants getting a little bit confident again very quickly. You saw extreme sentiment at the end of March. Then we had the pullback and talk about sentiment kind of getting neutral. But what I don't think anyone anticipated entering the week was to see another meme stock mania. And that's exactly what we got this week in terms of the meme stocks that we saw in 2021. Pretty much the exact same ones just went on fire once again. And the reason for this that people are pointing to is the fact that Roaring Kitty, the personality that really was around the original GameStop and AMC craze back in 2021, well, he came out from hibernation on X, and he tweeted this picture here, which likely means nothing to you or to most people, but the way people interpreted it is this is a meme to say that a gamer is getting ready. So he's leaning forward in his chair here and getting serious about the game. And people interpreted that as Roaring Kitty saying, now's the time to get into stocks again. I think he posted this on Sunday, and on Monday, we just saw an absolute mania once again in these select handful of meme stocks. There's about 10 different stocks, I think, that mainly participated in this, but of course, the two biggest being GameStop, which of course proceeded to go from around $20 a share to above 60 in 2 days. And then by the end of the week, it's almost back to where it started again. So very quickly fading. You're looking at AMC here, around $3 entering the week. It goes almost up to $12, and last pulled it at around 2 o'clock on Friday here, and that's $4 per share. So unlike the craze from 2021, so far it's really only lasted 2 trading days. We'll see what happens next week, but just of course insane that this is going on again. But the power of the meme, some would argue it's almost gotten stronger, because despite the fact that it's been a few years since Roaring Kitty has posted anything, I think he hasn't posted anything since the middle of 2021. The membership of Wall Street Bets, which is the Reddit thread that kind of sparked the meme stock movement back in 2021, has continued to grow. So the number of members here, you can see, even though meme stocks have before this week pretty much given back a majority of the gains and then some, you could see the membership here continue to go up. So as soon as kind of this became popular, and you can see how many million people viewed this, 27 million people viewed this one tweet, and then he went on to continue to tweet different videos and memes and things. I guess that people interpreted that that's a continued sign to buy. But the fact that the power is still there of the herd, right? For a short period of time, if a lot of people are just jumping into a particular security, it's going to go crazy. You're going to see 100, 200% returns in a short period of time. And you could see Roaring Kitty's Twitter account here. You could see before he tweeted that meme, he was actually losing followers around 466,000. And then very quickly, he's at now 1.3 million. So the next time, I guess, there's a meme, let's say he goes into hibernation again, the power has only increased here. Hopefully people will learn the lesson, though, that this is not fundamentally driven whatsoever. GameStop is still losing money. AMC is still losing money. AMC very close, I think, before this week. I mean, very close to running out of money. They actually use this, and they've done this a number of times, to issue new shares. So they use the jump to issue new shares and issues to raise capital as kind of a lifeline. So AMC, because of this rise, will actually exist for a little bit longer. But nothing fundamentally has changed for these companies, and buying something just on a meme, of course, is going to be a short-lived phenomenon, because the whole notion that people are going to hold these things forever, diamond hands, is absolutely false. You can see here it lasted 2 days, and the greater fool theory kind of ran out. And very quickly, if you have 100%, 200% profit, well, you don't want to be the last one standing. Of course, you're going to start to cheat and get out of that security as soon as it starts to move lower. And that's what we've seen. Now, it hasn't, not just AMC and GME. And as I'm reporting this on Friday here, there's one stock that really hasn't reversed course among the big meme stakes. And this is a penny stock called Faraday Future. It's an electric vehicle stock, and it absolutely went bananas. You're talking about from cents here to up to almost $4 a share, based on some meme, I guess, that was created, and people messaging boards hyping and pumping it up. But once again, which seems to be the common theme with all of these meme stocks, it's not based on anything fundamentally driven. If we see Faraday future here, it's net income, losing money every single quarter, and really was about to, I think, file for bankruptcy before this happened. The Nasdaq threatened to delist the company because it was trading at such a low price, 10 cents. And also the fact that it didn't issue its a 10K, it didn't file a quarterly report for the last quarter of last year, and didn't give really an explanation for it. They just didn't report for the last few months of last year. Not typically a good sign. And so obviously, I'm going to report on it next week and give you an update on this. This is pure speculation, and most people are getting involved in this because of just FOMO, and they're hearing about other people making money, and it's not going to end well for most people getting involved in this. Some people might get lucky, get in and out at the right time, but the most of the money is going to come in from retail at the exact worst time, and then they're going to be left as the bag holder in the security. And if you want to watch something, I think that really captures this. I don't know if you follow Dave Portnoy. He's the head of Barstool, and he's a very entertaining personality. But he was big into in 2020, 2021, publicizing kind of his trades in the stock market, and a lot of it was entertainment. He's a very entertaining, funny guy. But this week, of course, he went back. I don't think he's been talking about the stock market much of late, and I kind of gave up on it during the last meme stock craze. I think he lost a ton of money in it and said he's done with it. But you got to watch the video on X of him talking about how he just can't stand to see these stocks going higher. He says, I can't miss it. I have such an incredible FOMO. I know me, I'm getting the itch, I'm missing it. And then he reports that I think after that first day of trading, he jumps in to AMC and GameStop, and he's still in it now, and I suspect he's down on the trade now, so we'll see what happens. But it kind of just captures in real time what the average person is seeing and why it's that emotional real reaction to get into these things. They just can't stand to see it going higher. And he's even saying it, if you watch the video, he goes, I know the second that I get into this stock, you don't want me in it, because the second I get in, it's going to peak. And that's pretty much what actually happened this time. It happened the last time, and it's happened again. And it's very entertaining. He's got obviously hundreds of millions of dollars. So to him, losing 500,000 or whatever he bet on this is not going to break the bank. But it really captures, I think, what the average person is thinking and feeling. And if you just trade on emotions, if you trade on FOMO, it's not going to end well most of the time. So number 5, emerging signs of a leadership change. This was an interesting thing to see this week. The fact that copper getting a lot of attention. Copper's been running up for most of the year, but this week we saw just a real spike higher. It actually hit an all-time high this week, surpassing the prior high from a few years ago. And what we're seeing copper do is an outsized move compared to, let's say, the overall commodity market. It's up over 30% this year. And what a lot of people historically talk about is the relationship between copper and demand for copper and China. And because China was a growing country, copper being a big part of the big industrial metal, and a big part of that growth is the need for copper. And so a lot of people tied the two and looked at the relationship much more so than, let's say, the US, a more developed economy, more information-driven economy, more service-driven economy. China more tied at the hip. And the interesting thing was, a few months ago, copper was running up, and we saw the Chinese stock market hit its lowest levels in years. It was down actually 60% from its peak, while the S&P 500 is hitting all-time highs in early February. Chinese stocks just in the doldrums. But fast forward to today, very interesting to see. This has reversed. The Chinese stock market is actually up over 30% since those lows in January, and now actually outpacing the S&P 500, up over 15% versus 11 and change for the S&P 500. So just interesting to see this shift. I don't know if this actually means that maybe China is going to start improving now. I don't think anything has changed in terms of the housing market and the situation there, but just interesting to see the two of them operate here with a lag here this time around, where Chinese stocks are kind of catching up to that move in copper. And what we talked about in January, the sentiment for Chinese stocks was just about as bad as it could get, in terms of, unless there was an event where there was delisting or there was a massive fraud that they were going to say was being perpetrated by all of these Chinese companies, that it was kind of vulnerable for an upside bounce, because the Chinese government was talking about supporting the Chinese stock market at that point in time. I don't know what they actually did in terms of supporting, but they were claiming they were going to start buying Chinese equities, and perhaps they have. We've seen this huge run up here, and valuations were just so cheap that perhaps it's just a mean reversion move. But more interesting to me is the move in overall emerging markets, and depending on the index, China's anywhere from 20, 30, 40% of various emerging market index, so not insignificant. But you can see here the trend in terms of emerging markets versus US markets. It's been well over a decade of just severe, significant underperformance for emerging market stocks. This is comparing emerging market index ETF to the S&P 500, and you can see it's just pretty much a steady downtrend, lower, almost uninterrupted. And what you're seeing over the past month here, or 2 months, is just a little bit of a reversal, and it's still nothing to write home about. The question is this finally going to be the change in leadership that people have been talking about, waiting for? And of course, we don't know the answer. We only know that in hindsight. But if we're looking at year-to-date performance, it's still lagging that. So even after that huge run up, we still have emerging market stocks up around 8%, S&P 500 up over 11%. And if we're looking at MSCI EFA, that's trailing. So US once again still outperforming here. We're only in mid-May, but will this finally be the year where we see international emerging really show some outperformance here? I think a lot of people would be surprised by that, but they shouldn't be, given how beaten down that relationship is. And perhaps this is just the early stages of that occurring. So number six here, I want to talk briefly about the Walmart bubble, this concept that the former CEO of Walmart talked about after the Walmart's earnings report. It's a great report, beating on earnings, beating on sales in a time where it's been very difficult for other retailers. Walmart seems to be doing very well. And one reason for that is supposedly the fact that affluent shoppers have been moving to Walmart because prices elsewhere are getting so expensive. And what this former CEO is saying is that Walmart is not a company built on service. It's built on convenience and cost and assortment, so the variety of products, but not on service. And he's saying that the bubble is the fact that these wealthy consumers are buying here for now, but once they don't need to buy here, they're going to leave because they're going to start to value service as well. And I think the biggest part of helping drive the profits here is people going to Walmart for that grocery business where they've held the line on prices. So noticeable difference, Walmart, in terms of grocery prices versus a lot of other places. So wealthier consumer actually going to Walmart to reap those savings. And this former CEO is saying here that that won't last. So that's kind of a bubble. And he's viewing this as not actually a good thing for the U.S. economy, saying the fact that higher income consumers are going to Walmart is a sign, I think, that they're getting stretched in terms of this relationship between wages and income, and the fact that we've had just persistent inflation over the past now 3+ years. And if we look at retail sales, we got a report this week, I think, that reflects some of those comments as well. And here I'm showing you on the top chart here, overall retail sales up 2.7% over the last year. And that's well below the average in the last 30 years, which is around 4.7%. But importantly, you have to adjust for higher prices. So we have inflation running 3.4% over the past year. And even though sales are higher, that most of that, or more than all of it, is actually due to retailers charging higher prices. So that dollar level of sales is higher. And if we adjust for those higher prices, we're actually seeing a decline in retail sales over the past year. So I've talked about this has been a trend for the past few years. We've seen consumers pull back at retailers. Where are they still spending money? They're still spending money on travel. They're still spending money on entertainment. But if we're looking at goods at retailers, things like Home Depot, talked about that last week. We talked about places where people are buying goods like Nike and stores like that. We're just seeing a pullback in terms of the consumer pushing back against those higher prices. So something to watch, something interesting, that Walmart is a winner in the higher inflation environment, at least for now. Okay, I want to end number 7 here, something positive, as I always do, and that's a return to prosperity. This is a trend I've been talking about every month for the past year. First, I want to acknowledge the fact that inflation is a cumulative thing. So even though people are getting excited that core prices are back down to 3.6%, overall inflation 3.4%, much better than where it was in the middle of 2022. Of course, the cumulative effect of inflation has been enormous. And if we look at the last 4 years, we look at wages up 16%. Okay, that part's great. The difficult part is the fact that a lot of these categories that people spend money on are much higher. They've risen at a much faster pace than people's wages. And I think that reflects kind of the attitude of why consumer sentiment has been in the doldrums. But the good news is over the past year, we've kind of seen a sharp reversal of this. So we had 25 consecutive months where wages were trailing the rate of price increases. And now we have the fact that we have 12 consecutive months where people's wages, so looking at average hourly earnings, are actually higher than reported CPI. So that's a good thing. Now, this number is getting smaller. I don't want to see this go negative, which is why the Fed needs to hold the line and keep inflation in check, because we don't want to see inflation go back to 4 or 5%, because unlikely, I think, that you're going to see wage growth outpace those levels of inflation. So let's hold the line. Let's keep this streak running. I think this is what is keeping the U.S. economy going, is the fact that over the past year, we've seen incomes rise more than the rising prices. So yes, it's been a terrible few years in terms of inflation, but as long as we can keep this streak going, now we're moving back towards prosperity. If you look at any long-term chart of a nation in terms of increasing prosperity, it always begins and ends with this chart here. You just need to have wages going up more than prices, and people's lives will improve over time. And I'll end with this chart right here, which is great news. Best news in the CPI report is the fact that food inflation is still running very low here, 1.1% over the past year. So incomes are up 3.9% over the past year, and you have food inflation 1.1%. And that spread is definitely something to be excited about. I would love to see this number turn negative. I would love to see prices actually go down on a year-over-year basis. No, that's not the end of the world. We've seen that many times in the past 40 years. I'd love to see that again. But even at 1%, I'll take it. Much, much better than where we were a few years ago. All right. So with that, we'll end it right there. Thank you, everyone, for watching this. If you're watching this on YouTube, hit that subscribe button. Leave a comment. I read all of the comments. Try to respond to as many as I can. Have an awesome weekend, and I'll see you next time on the Week in Charts.